Okay, folks, I am live streaming. I'm trying to do this Google Hangout, and only DJ has responded. I'm not used to this Google Hangout. I don't know what's going on. I thought everybody could just join. Uh, DJ, it looks like you're the only one. Uh, it's not giving me any more instructions. So I don't know how this Hangout's going to work. Hello, has anybody else joined? Hello? Okay, I'm just going to start live streaming. I don't know if I'm presenting this on Hangout Live or not, but it will be on Moodle. I will record and drop it in Moodle. And right now we need to look at chapter 15. This is the last chapter on corporations. We're talking about investments and fair value accounting. Now, folks, I know we're behind a week. I miss being there with you all. Hope none of you all get sick. My cell phone number is 276-964-3431. Anytime you want to call or anytime you want to text during this lecture. Of course, if you look at it a day later, I will have my office hours today after my 3 classes. Please call me between 1:30 excuse me, and 3 o'clock today. Your test wasn't bad, it wasn't great, but we've got test 2 in. Test 3, we'll worry about that when the time comes. Proctor Track is going to be available for everyone. Hopefully you have internet at home, and of course a computer or cell phone that you can watch Moodle. We just need to get through this class, folks, and I'm here to help you. Call me, text me, email me, whatever you need to do. And if it's real important, I'll come to my office and meet with you if they'll let us in the building. Right now, I don't know how much of a lockdown we have. I think somebody may have just texted me. Let me check and see. No, none of y'all have texted me this morning. But we'll get on with chapter 15. That's what we're here for. Now, I still have my PowerPoints. I still have my solutions at home with me. I still have visual. As you can see here, I'll show you what's going on. Ooh, I'm in my man cave, and I don't look good on a screen. Of course, I don't look good in person either. But anyhow, that's my camera on visual screen, and like I say, I'm in my man cave, and you're just looking at a TV. I've got a table set up here with a chair I don't even like to sit to lecture, but anyway, that's what I'm doing this morning. So, hope I find all of you well and ready to learn accounting. So, here is some of our objectives. We're going to describe why companies invest in debt and equity securities. So, one chapter was corporation stock. Chapter 14 was corporation bonds. You had a test. This chapter is companies investing in other companies. And with today's market, it's bad. I've lost 35 or 40% of my retirement investments, but just hoping to come back. But describe why companies invest in other companies. Describe and illustrate the accounting for debt investment. Describe and illustrate the accounting for equity. Describe and illustrate valuing and reporting investments. Describe the fair value of accounting and its effect on the statements. In other words, you may buy stock for $10 a share and it's already up to $50. Do we report that? You will see. Describe and illustrate the computation of a dividend yield. Dividends coming in this chapter, not going out. This cash can be used for the following purpose. If a company has extra cash, invest in their own company. Invest in temporary investments to earn revenue. T-bill would be an temporary investment. CD would be a temporary investment. At least it'd be drawing interest. Invest in long-term investment in stock of other companies. That's where we are right here pretty much on number 3. Invest in cash in current operations. We can use it to replace, expand. I just noticed on TV where the Starbucks CEO is going to keep his employees paid for at least 30 days. He's still got 95% of his stores open in China. Starbucks is committed to keep his company going and serving people and paying his employees. Now we can use cash to pay expenses, suppliers, and interest to creditors and pay dividends to stockholders. But here we need to see the 2 different items. One is debt securities, notes, and bonds that pay interest and have a fixed maturity date. We may invest in stock, preferred and common of other companies. Then we have an ownership. Investment in debt and equity security term investments or temporary investments are reported in the current assets section of the balance sheet. So now we've got cash, merchandise inventory, accounts receivable, and we've got investments and current assets for some of these type of investments. The primary objective of investing in a temporary investment is to earn interest revenue, receive dividends, realize gains from increases in the market price of the security. Investment in CDs or deposit and other securities that don't change in value or disclose on the balance sheet as cash or cash equivalents. You know a CD can be turned into cash easy. A savings account can. Long-term investment involves the purchase of a portion of stock of another company. They usually have a strategic purpose: reduce cost, replacement of management, expansion, integration. A lot of these companies merge. A lot of companies have subsidiaries. All right, accounting for debt investment. So we're going to look at purchases of bonds, and we're going to look at the interest revenue, and we're going to sell those bonds. It's recorded by debit investment account for the purchase price of the bonds. Now, you may have to pay a brokerage fee. If it's charged, you add it on to the amount. Now, if we purchase bonds between interest dates, we may have to pay interest up front. All right, so here we're starting our entries on the purchase of bonds. Assume that Homer Company purchased 18,000 U.S. Treasury bonds at their face amount. Face amount, 18. Now, U.S. Treasury bonds are not necessarily quoted in 1,000 like corporate bonds we learned a while ago. All right, but they're investing 18,000. Now, these bonds could be sold at a premium or discount, but probably hardly ever. Now, these bonds, their face amount on March the 17th, plus accrued interest for 45 days. The bonds have an interest rate of 6% payable on July the 31st and January the 31st. So it's paid 2 times a year, just like corporate bonds. Now, here, we've got to pay for this interest. These bonds paid interest on January the 31st. So now we've had February and March, February and 17 days in March, 28 and 17 makes 45 days. The bonds have an interest rate of 6%. That's 3% semi-annual. All right, calculate the interest. Here, use 6%, 45 days, times 18,000, and you'll get 135. And it explains, because the bonds are purchased on the 17th, it's also purchasing accrued interest for 45 days. So now we've got interest receivable because we will get this back. It's not interest revenue, it's interest receivable, debit. Now they received interest on these bonds. That's 3% or 6 times half. All right, that is $540. But now we paid for 135 of that, so we credit our interest receivable to get rid of it, and we have earned $405 from March the 17th until July, whenever they paid. Well, here it says on July the 31st is when we received our interest. Now, their accounting period ends on December 31st. That means we got an adjusting entry. So from July the 31st, we got 5 months. We got 5 over 12. That's August, September, October, November, December. 18,000 times 6% times 5 over 12. The adjusted entry recorded accrued interest is as follows. We simply debit interest receivable and we credit interest revenue. For the year ended December 31st, Homer Company will report interest revenue of the $405 plus the $450. That's $855 on those bonds. Now the receipt of the interest, you're going to get $540. You've already recorded $450 of that as an adjusting entry. Get rid of it. And your interest revenue for 1 month is the rest of it, which is $90. Debit cash, credit interest receivable, credit interest revenue. We had that a little bit before on notes receivable. Same concept, same idea. Now you can look at these interest timelines. Payment date is on January 31st. I don't know if my pens will work or not. Sometimes they'll work on these PowerPoints, and sometimes they won't. Right now, I don't see any way to even get a pen. So I'm going to have a little bit of an ordeal getting back into things just like you are. But we're in this together. All right, but the interest timeline is here. I'm going to see if I can write. Now, I cannot. But here and July somewhere. Interest payment date, interest receipt date, also on January 31st. All right? You can look at that in your book. The sale of the bond investment normally results in a gain or loss. If you sell it for more than you paid for it, you got a gain. Less, you got a loss. Assume that on January 31st, Homer Company sells the treasury bonds at 98, which is a price equal to 98% of the face amount. The sale results in a loss. because we know that 98% of 18,000 is 17,640. We had a loss, 360. Now here's the bond. We debit cash, debit loss. I've got sinus drainage. Forgive me for coughing. It's not the C virus. Anyway, investments, U.S. Treasury bonds. Speaking of the virus, West Virginia moonshine makers can't make it fast enough. People are buying up moonshine. Maybe they're using it as an alcohol disinfectant. Or if they have to stay home, maybe they're going to feel good when they stay home. See, they sold these on January 31st, so there was no interest involved. That was the payment date, and they'd already received their interest. Now, if they sold it on January 1st, this company, whoever's buying them, would have to pay 5 months accrued interest. Now, that would be under other income loss on your income statement. All right, take a moment. I know you can't communicate with me, but think about it. We purchased for cash $40,000 of 10% bonds at 100% plus accrued interest of $500. Now we know we're going to have to debit investment in bonds, $40,000. We know we're going to have to credit cash of $40,500. Now we're going to have to credit 500. What? We're going to have to debit 500 interest receivable. So debit investment 40,000, debit interest receivable 500, credit cash for 40,500. Now we're going to receive the first semi-annual interest payment. Now what is 10% or 5% really? But 10% of 400,000 we know would be 400. And we divide that by 2 or 6 months over 12 or 5%, it would be 2,000. That would be 4,000. So now we got 2,000 of interest that we're going to get paid. So what we're going to do, we're going to debit. I think I see my pins now. All right. I'm in business. We're going to debit cash for 2,000. We're going to credit interest receivable for 500. That leaves 1,500 interest revenue. Now we're going to sell the bonds. So 30,000 of the bonds at 102. Well, what is 30,000 times 102? 102%. All right, that'd be 30,000 plus what's 2% of 30,000? Maybe 600. So we're going to sell them for 30,600 if I'm calculating correct. I don't know that I'm calculating correct, folks. All right, but now we have accrued interest of 110. So it looks like we're going to sell the bonds for 30,710. Well, I'll see if I'm right. I'll scroll on down. I got a text. I don't know who it might be from. Well, it's not from one of my students, so here we go. We debit investment 40, we debit interest receivable 900, and we credit cash for 40,500. Okay, now we've got a debit to cash 2,000, interest receivable 500, and interest revenue 1,500, as I said. Okay, now we're going to sell them for 30,710. because interest revenue was 110, and we got a gain of 600. That's at 2% of 30,000, and we got investment credit for 30. Okay, folks, that's your three main entries when we are talking about investing in bonds. This could be a note, investment in a note. All we had done is put note here instead of bonds. All right. Now we're going to invest in preferred or common stock. We're going to be the investor now, not the company people are buying our stock. We're buying other company stock. Now it depends on the percent of the stock. The percent of the investee's outstanding stock purchase determines the degree of control that the investor has over the investee. This in turn determines the accounting method used. Alright? You might buy 10% of the stock, 20% of the stock, 40% of the stock, 51% of the stock. 51% you control it. 40% you have significant control. But 20 or under you don't. So there's two different methods. One method for minor investment, another method for major investment. Now here's your percents. If it's less than 20%, we have no control, and we use the cost method. If it's between 20 and 50, we have influence, equity method. And if we have greater than 50, we've got control, consolidation. I don't believe we fool with consolidation. That will be safe for intermediate accounting. Well, it's about time that Carl Cooper walked in. I don't know if this hangout's working or not. I'm just going on with class, and it will be recorded and dropped into Moodle. Alright, if the investor does less than 20% of the outstanding stock, the investor is considered to have no control. And it's called the cost method. It's easy. Alright, we purchase the stock, we receive dividends, we sell the stock. That's the only three entries. Purchase, dividends, sell stock. Purchase the stock, you do add the broker's commission. You purchase stock at $49.90 a share times 2,000 plus 200. So you have $100,000 in that stock. Okay? Debit investment, stock, credit cash. Now, dividend is put in dividend income. Remember this. Under the equity method, dividends are put in the dividend income. It will be other income. The sale of stock results in a gain or loss, just like the bonds. So let's see what's happening. We're going to sell this stock for $54 a share. My Disney stock was up to $142 a share. Now it's about 90, 91, 92. For every 100 shares, it was worth $14,200. Now it's worth $9,000. It's went down a good 40% because of this virus. Okay, so proceeds is going to be $81,590. All right, we paid $75,000 for this amount of stock. and we're going to take out, there is a commission. The sale results in a gain of, see here, you multiply 1,500 shares times 54.50 minus 160 to get this amount. You paid 75,000. So here you see items here. See, we paid 100,000 for these shares, and we're selling 15,000 out of. We're selling 3 fours, so really 3 fours of 100,000 would give us the 75. But there's 2 or 3 ways to calculate that. So debit cash, credit gain, credit investment. You would debit a loss, you credit a gain. And remember, this is, excuse me, the cost method. Take a minute and think about the journal entries here. What would you debit for how much? 1,500 shares times 24 plus 40. You got a 60-cent share dividend. 60 cents times 1,500 shares. There would be cash, debit, and credit dividends. Now we're going to sell on October the 11th, 750 shares. It looks like we're selling 11,750, but we're selling 750 shares, which is half of the 15. All right, companies were sold for $20 share less 45 commission. Well, we bought these things for 24. We're selling for 20. We're going to take a $4 loss, plus we're going to subtract out this commission. So let's look at the ins and outs here. We debit investment for $36.40. That's price of stock plus the commission. We receive a cash dividend. We debit cash and credit to revenue. And when we sell them, we know we took a $4 loss plus that brokerage fee. All right, 750 shares times $4 is 3,000 minus 40. Wait a minute. 750 shares times 20 minus 45. Now, if the investor purchases between 20 and 50, the investor is considered to have significant influence. Your vote counts. In this case, it is assumed that the investor purchased the stock primarily for strategic reasons, such as you're buying out a lot of stock in your supplier. So if it's between 20 and 50, we got to use the equity method. So we got the cost method. I can't write anyway, let alone with a mouse. And we got the equity method. Whoops. I'll just go with EQ, but we know it's the equity method. Under the equity method, it's adjusted. These adjustments are net income. The investor records its share of the net income of the investee as an increase in the investment account. Dividends is a decrease. Now here, I would advise you to draw a T account. Draw yourself a T account. Put your investment in it. Debit investment, $350, credit cash. I would draw a T account and I'd put that $350 debit. Now, this company has net income of $105,000. Well, we're supposed to get part of that. What part? How much did we buy? We purchased a 40% interest. We own 40% of that company. We get 40% of that company's income. And here it is, 40% of the 105. We debit our investment again. That increases. So I want you to do a T account. Put that investment in that T on the left side. And we credit income from Fisher Company. Flanders Company, sorry about that. Okay. Well, this spring, guys, there's no baseball. Hatfield and RJ and Carl Cooper. I don't know if I have any tennis players. I don't think so, but there's no tennis. It sucks. It's a bad way to end a semester. And to lecture and to give tests. And I don't know what will happen about graduation. And we'll worry about a test when the time comes. Anyway, we debit cash and we credit investment when we get a dividend. Before, and we get 40% of these dividends, remember, 40% of everything. 40% of 45,000 is 18,000. All right? Before, we would have debit cash and credit dividend revenue under the cost method. This is the equity method. Repeat. A gain or loss is normally recorded from the sale of this investment. All right? And we got to look at the book value. That's why you needed a T account. Okay? Put that initial investment here. Put that part of their income here, increases. And when we get money, dividends, decreases. So, investment plus income plus dividend and minus gives you a balance when you want to sell. Assume that on January 1st, this company sold Flanders stock for $400,000. A gain, they tell you, of 26. All right, 400,000 minus our book value. Had you drawn a T account, you'd have got that book value. We have a gain. So just like the cost method, we debit cash, we credit investment, and we credit gain. And my other guys in the back, I hope you're watching this. If you have any questions, please text me. That's Tony and Marcus. And it's not Antonio, but Antonio knows who I'm talking about. Then my ladies up front, Alicia and Amy and Brooke. So folks, I mentioned those names so you won't forget who your classmates are. Hopefully y'all contact one another for working together over the phone or email, explaining the problem, whatever it takes. But now, folks, I need you to tell me what I need to do to help you. Email me, text me, call me. I want to see you get through this course successful. All right, on January, this company acquired 35% of the outstanding stock of Bryant Company for $140. All right, for the year ended, Bryant Company earned $44 and paid dividends of $20. Draw yourself a T account. Now, I don't know if I can get one here okay or not. Now, we're going to pay $140,000 for this company. I can use my pen. I hadn't thought about that. And we're going to get income of 44. Bryant Company earned income of 44. But now we only get 35% of that. What's 44,000 times 35%? All right. We would debit that also. That'd be 15,400. All right. Now, 20,000 times 35%. That would be $7,000. Now, I would put my $7,000 over here. Now, subtract. We've got 155,400 minus 7. That would make it 148,400. If we sold it, we got 148,400 in it. We would debit cash for 148,400, and we'd credit our investment. Now, if it's more or less than that, we would debit or credit a gain, debit a loss. Now, consolidations, we own more than 50%. I don't think this book's going to do a whole lot with consolidations. I don't think they will at all. But consolidation is like husband and wife married. If the husband has $10 in his wallet and the wife has $100 in hers, that's the way it usually goes, then if we consolidate their money, the husband has 15 and the wife has 100. So we know consolidated they have $115. Now, as far as the virus goes, West Virginia had some cases up in eastern West Virginia, and the nearest case was Bluefield College. But that student did not live in Southwest Virginia or in West Virginia, and they have went home, so they're not in that area. So far, I don't know of any known cases. Maybe there's one in Princeton, I'm not sure. But anyway, folks, be careful, wash those hands, use that hand sanitizer if you can find it. If somebody figures out why there's a run on toilet paper, please email everybody and let them know why people are hoarding toilet paper. And is your family hoarding food? The head of FEMA says don't get more food for a week. Well, my daughter down in Knoxville is paranoid. They've got 5 cases down there. She's a hoarder. Her husband went duck hunting, so she has 40 ducks frozen in the freezer, 2 turkeys. She has 10 chickens, so she gets eggs every morning. She has 2 dogs and 5 cats and 2 pigs. She went out and bought 1,200 pounds of food for those animals. Now that's being paranoid. I think we will have food, okay? It might be hard to get hand sanitizer or chicken or toilet paper. We will survive, folks. Now, if you own the majority of a corporation, you're the parent company. I believe Fiat and Chrysler join. I think Fiat owns Chrysler. I think Ford used to own Jaguar. I don't know if they sold it out or not. General Motors, they probably own Delco Battery. That's one of their suppliers. But we're talking about consolidated statements, and I don't think the book's going to ask you to do a whole lot with that. But now, here, they will ask you to look at this. What is the value? Whoops. Didn't know I could move that. What is the value of our securities? You can pay $1 for them, but they may be worth $10. What do we do? This is the first thing we had when we bought bonds, and we debit investment for bonds and credit cash. That's trade securities. They can be held by banks, mutual funds, insurance companies, and so on. Because trade securities are held as a short term, they're reported at their current value. If we paid $10, we've got $10 on the balance sheet. Trade securities is valued as a portfolio group of securities using security fair value. Fair value is the market price that the company would receive if they sold today. The double talking here, that we'll have to dig out the difference. Reported as a current asset. No, they're not double talking. Reported as a current asset. It didn't say that you report $10 for $10. We will look at their value. We'll have to look at their fair value. Fair value is the market price. So we paid $1 for something, and the fair price is 10. We can report 10. Look at this group of trade securities. We paid $24,000 for them. And we're going to look at their fair value. This company is worth $2,200 more. This company is worth quite a bit less, $3,500 less. This company is worth $2,600. But altogether, if we sold them today, we would have a gain of $1,300 if we sold them today. All right, an adjusted entry is made with that $1,390. Did I? 25.3 minus 24, that's 1,300. I may have missubtracted. But we debit valuation allowance and credit unrealized gain. Unrealized, because we didn't sell them. Unrealized. Now that's on our trading investments. So we've got trading investments, 24, and we've got plus valuation allowance, 13. On our balance sheet, we're going to show that we have stock worth 25.3. And that's okay. That's understandable in all accounting world. Now, if it was less, the adjustment would debit unrealized loss. Unrealized loss will be reported on the income statement as other expense. Valuation allowance for trade securities will be shown on the balance sheet as a deduction into value. It works itself out. January 1st, valuation allowance for trading had a zero balance. Alright. On December 6th, the cost of trading portfolio was 79.2, but it was worth 76.8. Now here's what you do on the balance sheet. These are available for sale. These available for sale securities. All right, these are also an investment. And we show the fair valuation. That's how we show them on the balance sheet. Called available for sale. We have that valuation allowance. Here on December, we had a fair value of 50. We paid 45.7. We know there's an adjustment. But now here is the other method. Back here, this pretty much come with the cost method. Pretty much was the cost method. Now, we're getting into the held to maturity securities. And that's bonds and notes. I want to show you something here. Now you can look at the difference here. Trade securities, unrealized gain or loss in the income statement, available for sale securities, accumulated realized gain or loss is recorded in the balance sheet. Stockholders' equity plus under assets investment. Held to maturity security, not important, no adjustment. So we'll look and see what they say. So Morning Joe Coffee has their trade investments plus valuation allowance, total of $465. But down here, you've got investment in Cafe Coffee equity method. That means they own over 20%. Investment's $565. All right, let's see what we have here. This is the balance sheet. Other revenue expense, interest revenue and interest expense, loss on disposal of a fixed asset. You sold land for less than what you paid for it. Unrealized gain on trade securities and equity income in this coffee company. And that's how it shows up on your balance sheet. Your income statement. we know that fair value is fair price. Fair value assumes that the asset is sold under normal business conditions. We use GAAP. When an asset is reported as its fair value, any difference between the original cost or prior period's fair market value must be reported as a valuation allowance. We just did that. Effective fair reporting on the financial statement that will increase it or decrease it. Although trading securities are reported at fair value in the balance sheet, changes in that fair value are not reported as part of the equity. Rather, the unrealized gains or losses are reported on the income statement. When you put it on the income statement, it ends up in the equity. It goes into retained earnings. Dividend yield. Quite easy, I hope. If we get $100 interest on a bank account, and we had $2,000 in that savings account, well, what is 100 interest divided by your investment? I think that works out to be 5%. It'd be great to get that as interest now. It's not available. So here we go with dividend. Here we take the dividends per share and divide it by the market price per share. I'd have to give you that market price per share. All right, a dividend yield, if a company is profitable, it's a function of management, alternative use of funds. They pay out dividends. Now, the dividend yield will vary from day to day because of the market price. Recent dividend yields have been, if you had Google, none. Today, though, Google would probably have a good dividend.
According to Dividend.com, the average dividend yield for companies in the industrial goods industry is just 1.76%.
The average, somehow I don't know, my phone picked up my question, and Google was telling me that the average dividend yield for industries are 1.7. Well, here, Coca-Cola was paying 3.1, Best Buy 3.6, Duke Energy 4.1, Microsoft 2.8, and Verizon 4.4. Well, let's say you own some of Verizon. All right. Let's say you had 1,000 shares. And you get a 4.4% dividend. That'd be on investment. Maybe you got a dividend of $100. That'd be 10% per share, but I don't know what you paid for the shares. All right. Now, that's one way of getting income from a corporation. But let's say you paid $2,000 for that 1,000 shares of Verizon. And let's say you could sell it for $3,000. So we got a capital gain and we got dividend. Two ways to gain if you own stock. There's one big way to lose if you own stock. If a disaster like the virus has hit our company, we lose. Most of the professors have lost in their stock plans or retirement. I have a sister in Ohio. I think she had about $1 million, her husband, when he retired in the stock market. They've lost 400,000. But they're alive and healthy. That makes the big difference. All right, this company had a market price of $58 a share. Shelton paid an annual dividend of $2.90. Compute the yield. Well, here it is 5%. Divide $2.90 by 58. All right? So do this calculation. You got $5 a share when the market price, when the market price of your stock was $100 a share. Well, you know, if you divide 5 by 100, what are you going to get? Every time, 5%. So you're dividing the dividend by the market price. Very easy. We'll get all those ratios in a future chapter. This one will be repeated. Now, in the appendix, I'm not going to say much about it today. I was just supposed to run this class for an hour today because that's when I had it set up to do Google Hangout. Now, hopefully, folks, I can get Google Hangout fixed, whereas you can join me at 9:30 on Tuesday, Thursday for class, and you can ask me questions real time. I can talk to you real time. Hopefully, I can click on your face and see you. I thought I had it the other day. They gave us a good session. It looked easy. I set it up. It came on this morning. I only had one person to try to join me, and that was RJ. I sent out emails, I guess, a couple of times. I put the link on Moodle, and I put the link in your email. They said we could do that instead of typing in each one of your email addresses. But I need your all help if I can get this thing going by Thursday to be here at 9:30 on Thursday. And please keep up with these lectures. Please watch Tuesday on Tuesday and watch Thursday on Thursday. Please do not get behind, folks. These are trying times and you got to get tough and we've got to learn some accounting. Now, for Thursday, I need you to be working on Cengage. You should have everything you want done on chapter 13 and 14 Cengage. Now, I want you to do some practice exercises for Thursday. I want you to do exercise 15-1. All right? 15-4. I didn't bring a pen with me. All right? We got to practice some of these. 15-6, 1-4-6, 7, 8, 11, and that will be okay. Please attempt those. Please work on Cengage. Now, I hope to see you Thursday on Hangout. If I don't, then I'll be lecturing again, and I'll be dropping this lecture in Moodle. Thank you all. Have a good day.